Hello, everyone, and welcome to another options educational session. I am Ed Modla, the Director of Retail Education at the Options Industry Council. I've been in the business since 1997 in a variety of formats: floor trading, electronic trading, brokerage, and now education and support, ultimately supporting the options exchanges and the clearing corporation, which is really where all the funding comes from for our efforts. Today's topic is key points to know about selling options. There will be a mixture of discussion on strategies involving selling options, as well as conceptual ideas that you need to understand as well. Here is our disclaimer, which we will get out of the way, and then about OIC, who we are. Our website is optionseducation.org. There is plenty of written material, podcasts, videos, and an events section where you can sign up for our in-house monthly webinars. We have a good session coming up next month. I wanted to mention October 23rd. One of our keynote speakers will be Larry McMillan. Some people call him the Michael Jordan of options education. He has one of the most popular books ever written on the topic. He's going to be giving one of our webinars on October 23rd. So if you wanted to sign up for that, come to the website and check out the events section and sign up for it there. And make use of the investor services team with any questions you have about our education or any specific options questions. It's a team of professionals you can reach by email, services free of charge, and they can be reached at options@theocc.com. Usually when I give presentations, a certain number of people in the audience will benefit from something that is more basic in nature. So I'm going to start there today, some options 101, rights and obligations, and then the concepts of moneyness, time value, and theta before finishing up with comments and an explanation of the exercise and assignment process, as well as pin risk. This presentation more or less was put together for a basic level crowd. I feel like this particular audience is a bit more sophisticated than the majority of the audiences that I speak to, so I will maybe go off the slides once or twice, specifically when talking about theta, and maybe inject some further commentary there about time decay, and probably weave in a thing or two on other Greeks like gamma and vega, and some comments on implied volatility as well. All the while, we will focus our efforts from the angle of the option writer, or otherwise known as the option seller. But it's also useful if you're taking one side of the options contract, one side of the trade, to understand the other side. So we'll have to get through the buyers as well. And that's going to be the first slide here. From the buyer's perspective, what are options holders trying to accomplish when they purchase an option? Whether it's a call or a put option, an option buyer is paying money up front to own the right to execute a particular transaction in shares of stock, whether it's buying or selling shares, it depends on whether they buy a call or a put, but ultimately they are purchasing the right to own the choice to execute this particular transaction, and they have a market outlook that is either bullish or bearish, not neutral. This investor has an opinion that the stock or underlying is moving higher or it's moving lower, and they're trying to capitalize on that. To state it more generally, option buyers want movement in the stock price or the underlying price in the direction, in the case of calls, higher, and if it's puts, lower. They're looking for movement. Trading firms or professional trading entities might be buying options because they're trying to purchase volatility in the marketplace with the expectation that it's going to go higher. That certainly can be a motivation for most investors. That is not the motivation. That type of analysis can be a bit complex, involving heavy data feed regarding historical data of the stock price movement, the current level of implied volatility, historic levels of implied volatility, and an analysis of the difference between those. That all goes into a thorough analysis of current volatility levels and where they might be headed. Investors can do it, but the majority of investors who are buying options are looking for movement The motivation to buy an option is to capture deltas or to get long delta or short delta in exchange for the time decay. Now they paid the price up front, that's the premium and the cost that they incurred. What they suffer is the loss of time from one day to the next. The buyer needs movement in the right direction within the right period of time and to a certain magnitude. All of those things have to occur for the option buyer to make money. So buying deltas, looking for a move one way or the other. Option sellers have a different motivation. It's very simple. Option sellers are trying to capture the premium they receive from the options contract. That's it. And we'll see in the examples in future slides that more specifically, option sellers are looking to capture time value, that extrinsic value in the option contract, the part that decays from one day to the next. That is what option sellers are looking to capture. It's cash that comes right into their account, and along with that, the seller or writer of the contract accepts the obligation to take the other side of the buyer. In the case of calls, that would be to sell shares at the strike price if they are required to do so, or buy shares at the strike price if they're required to do so. There's a significant amount of risk if you just trade these as outright positions. We'll have the profit and loss graphs coming up here on the next few slides. But to state it in the same terms as I did from the buyer's perspective, option sellers give the buyer the deltas that the buyer wants in exchange for the option premium. And there's different strategies that you can use when you're selling options in conjunction with buying options or owning shares of stock. But those are the four pieces. You can put them together in many different ways, and that would speak to the flexibility of the options product itself, and we'll get into a little bit of that as well. First, just looking at the outright trade. Now, selling naked calls, the first thing I'll say about this is that most investors will never do this trade. It's the highest risk options trade that exists. It would be required to trade this in a margin account, and it's very similar from a risk perspective to shorting shares of stock. Some investors might think, well, I do short stock, so maybe I would consider this. Well, it's different. Your risk to the downside is similar to that, but the profit potential is not similar to shorting stock. In the case of selling calls, here we have the 50 strike price call trading for $2. That equals $200 of actual cash that changes hands when selling this option. The most you can make when you sell an option is what you sold it for. So as you can see, with the significant amount of risk to the upside of the stock moving higher, there is relatively limited possible gain here of $200. And then this is naked call, no other position. You have no other options position, no stock position at all. This is just the outright position of naked call. It's important to understand this when you're looking at doing other more sophisticated strategies, because it all starts from here. And then when you add different pieces to it, you change the risk profile dramatically. But understanding the most basic level, and that's selling the naked options, is where to start. So that's selling naked calls. What selling naked puts means is that you actually don't have the cash to buy shares, and you're trying to sell a naked put, again, on margin, to profit just from selling the put option. You don't have any other position, you don't have any stock position. So in this case, it's just like the call side, exactly the same. The 50 strike we sold for $2 or $200. Most we can make is that amount, 200. So very limited gain as long as the stock stays above 50 and we are not obligated to do anything with respect to buying shares, or we don't have to buy back the option contract for any amount. That maximum gain will be received in the amount of $200. Maximum risk is substantial. On the previous example, the risk was similar to shorting stock. In this case, it's exactly like buying stock. We have a little bit of a buffer from the 50 strike and a break even of 48, but below 48, we are effectively long shares of stock and have a risk profile associated with that. Now, when it comes to reaching expiration and holding positions, one thing I want to point out up front, most options are not held until expiration. There is a myth that exists that most options expire worthless. I've heard various numbers, 70%, 80%, 90% of all options expire worthless. And that's what sometimes leads investors to think, well, I'm just going to sell options because it works almost every time. And it's a myth. It simply isn't true. The vast majority of options never reach expiration and are closed out. So if you sell a call or sell a put, what that means is you're opening the transaction on the sell side and then following that up with a buy to close transaction, exiting before ever reaching expiration. In that case, the option profit or loss really cannot be determined. The industry doesn't know how profitable that trade was. All the industry knows is that the trade is closed. The remaining options that are held through expiration, of those, the vast majority, maybe 70, 80, or 90%, expire worthless. And that makes sense because there's no value left in them. So the ones that are actually held all the way through expiration couldn't be traded out of. So of that much smaller segment, the majority of them expire worthless. And that's where that myth comes from. The myth ignores the 70 to 75% of all open contracts that are closed prior to reaching expiration and only focuses on the remainder, and it really tells an inaccurate story. So if you're thinking about selling options, that should not be a motivation for doing so. Some key terminology, a couple slides here on that before we get into strategy, because I'm going to reference these terms: in the money, at the money, and out of the money. You certainly may have heard of these before. One thing I'll say about that is in the money, the description from the buyer's perspective, an option is in the money if the option holder owns the right to execute a transaction in shares of stock at a better price than currently available in the open market. In the case of call options, an in-the-money option means the strike price is below the stock. The option holder who has the right to buy shares at 40 with the stock price trading at 50 has an in-the-money option, and then you can further calculate how much is it in the money, and that would be by $10 in my example. Out of the money for calls means the strike price is higher. There is no in the money amount, it's out of the money, and you can also calculate how far is it out of the money, but there's no value there, there's no inherent value. And for put options, it's the opposite, same definition. The owner of a put option who has the right to execute a stock transaction at a better price than the open market will give him is an in the money option, but for puts, that means the strike is higher. The owner of an 80 strike put option with the stock trading at 70 owns the right to sell shares $10 higher than the open market value or open market stock price. So that would be an in the money option by $10. And for out of the money, the strike prices for put options are lower than the stock price. The moneyness, whether it's in the money, at the money, or out of the money, really has nothing to do with profit. There isn't a direct relationship there. There's an indirect one. If a call buyer purchases a strike price that is out of the money, they want that option to become in the money. They want the stock to move in their favor, so it moves up the chain of moneyness and becomes an in the money option and continues to grow in its intrinsic value. So the change in status has something to do with it, but just the fact that an option becomes in the money does not mean that a trade is profitable. Profit is simply calculated as the difference between what you bought an option for and what you sold it for. This is important to understand because it helps calculate intrinsic value and time value, which is essential when you're evaluating the construction of a position or when you're managing a position that you have moving forward. And that'll become clear. The examples and strategies that I go through are going to be very simple, but I'll try to highlight these elements because doing this calculation on moneyness, intrinsic value, and time value is very important because sometimes there's a clear position management technique that you would be aware of if you're doing this type of analysis. Now, once we reach expiration time, all at the money and out of the money options are going to expire worthless. They'll have no value. So once expiration is reached, time value is gone. So let's look at that with an example as well. Time value, also known as extrinsic value, is the amount of the premium above its intrinsic value. Intrinsic is very simple to calculate. It's either 0 or it's the in the money amount. Beyond that, whatever's left over is time value. And I'll separate these two in another way. The intrinsic value is sensitive to stock price movements. The time value is sensitive to a number of other factors, including the passage of time, the movement of volatility, changes in dividend payments. There's a number of different factors in time value. It's a rather complex calculation to go through, but knowing how much is there and how much it changes from one day to the next is what you're trying to understand. So with shares trading at 77.5, an investor sells the 75 strike call option at 350. First question is, what's the moneyness of this option? The owner of this option has the right to buy shares at 75. That's better than 77.5, so it's in the money. Simple arithmetic, it's in the money by $2.50. So there is intrinsic value in the amount of $2.50. The option traded for $3.50. So that means the extrinsic value or time value portion of this premium is $1. The seller of the call option is trying to capture $3.50 only if they want short deltas and they're bearish. That is the motivation of the call seller. If they owned shares of stock, say from a lower price, then the seller of this call option is only trying to capture $1. That's because they own shares, and by selling this option, they are willing to sell their stock $2.50 below the current value. The only thing they're trying to add to their bottom line or portfolio return is that $1 of extrinsic value. And you can track that. I'm going to walk through that as we get to the simple strategies on the next slide. But a number of different factors go into what time value is made of. And it's also important to understand that time value can disappear and then reappear. Once it's gone, it doesn't necessarily mean it stays that way. The simplest example I can give you is if an at-the-money option today, which has no intrinsic value at all, is trading for $2. And for whatever reason, let's say it's a 70 strike call option. I'm gonna go through an extreme absurd example, which is something I do very frequently when I teach. If the stock all of a sudden news broke that it was going bankrupt and the stock dropped all the way down to $10. This is a 70 strike. There'd be no value left in that option. It's deep, deep out of the money. All the time value disappeared. And then an hour later, news broke that that was an inaccurate fake news story and the stock went right back to 70. All of a sudden, it's at the money again with the same length of time till expiration. That time value came back as the option moved from at the money to in the money back to at the money. Same thing can happen with the effect of volatility. You can have a decrease in volatility followed by an uptick in volatility, and that changes time value in both directions. Understanding all of that will help you keep track of the price of an option over time and understand why it moves the way it does. It's rather interesting to absorb the fact that time value can disappear and then come back depending on market circumstances. So here's the strategies, the simple strategies that I will walk through. First, the covered call. And I said in the beginning, it's very rare, if ever, do I speak to an investor who is selling naked call options. And some people do that, but it's very rare. Most often, selling a call option is done when the investor owns shares of stock. And in that case, long stock, selling a call option would serve as almost like a limit order to sell their stock at the strike price. The motivation for selling a call instead of using a limit order is to get additional income and premium in the form of selling the option. If the stock doesn't move, if it drifts very, very slowly higher or lower, that premium can be kept and the investor can continue to sell options moving forward at different expiration dates. Now, a couple things about this. Let's go through what ifs. Certainly, the risk in this position is if the stock moves lower. You own stock, you have a bit of a buffer to the downside in the amount of the premium that you receive from the call option, but that's it. You stand to lose if the stock moves lower, and especially if it moves lower considerably. So to the downside, you're managing your risk tolerance. How much can I afford to give back? And when do I need to get out of this trade? One important thing to note, since most accounts don't have approval to hold a naked short call option position, if you do see the stock trending lower and you want to get out of this thing and you say, okay, the call option premium gave me a little bit of an added buffer, but I'm done with this trade, undoubtedly you will have to exit both the stock and the call either at the same time or buy the call option back first and then sell the stock. This always comes to my mind because I was in the futures business back in 2010 when gold was trading at crazy levels and the volatility was absurd. And I was working with plenty of clients that had long futures positions in gold and short calls. And on days when the market was down heavy, in the futures markets, you're very leveraged. On days when the market was down by large amounts, these investors were trying to get out of their futures contracts and getting trades rejected because they had open short call positions that would have been exposed. They had to close those calls first. And when you're in a panic situation, which is what happens when the market crashes, you might not be thinking clearly. And a lot of clients at our desk were not, and they were confused about having rejected orders and watching their accounts get blown up in minutes. And trying to frantically decide what was going on, not realizing what they were doing. They own the futures and were confused. Why can't I sell them? Well, you have short calls, and exposing them was something they didn't have permission to do. So be careful if you're getting out to the downside. Now, what if the stock doesn't go anywhere? You have a covered call position, stock's at 65, you sold the 70 strike call option, nothing happens, stock doesn't move. Well, that's okay. You made a little bit of money on the calls. You didn't waste your time on it. A lot of investors will say, well, I'm just going to sell it again. I'm going to sell them every week or every month and keep doing it over and over and over again. It really is a good strategy to consider. What I always caution investors is don't fall into a habit of blindly doing something over and over and over again without reevaluating. Just make sure that if it worked yesterday and it works today, it might not work tomorrow. So reevaluate, make sure it's still the position you want, it's still the exposure that you want to have, and then decide what you want to do. Maybe circumstances have changed. You don't want to do the covered call at all. Maybe you're bearish and you want to get out. Maybe you're more bullish. You don't even want to sell a call option, or maybe you want to sell a different one. So just reevaluate and then reapply. Now things get more interesting from my perspective if the stock moves higher. One thing I hear from investors with this position is, and I have a covered call position, my great trades, my best stock positions get called away, and I find it frustrating, and I understand how that works. And there's a couple things there. First of all, active position management can prevent that. You can watch the stock move, and if you really think the stock's moving higher, buy back the option. If you were extremely bullish, you would have never sold it in the first place, so it's really not the fault of the strategy. It was the fault of your market analysis. You didn't think it was going to blow up to the upside, so you sold the call option, and that's where the problem occurred. But something else, a few other things. You can choose variations of selling covered calls, and this comes into play when you have a fairly large position. Frequently we find ourselves not just trading with 100 shares, but maybe 300, 500, or 1,000 shares. In that case, you can do a number of things. You can sell fewer calls than the stock you own, maybe 3, 5, or 8, depending on how aggressive you want to be. So if you do get that blow to the upside, you're not called out of all of your shares and you can capitalize on a run higher on a certain portion of your position. You can also stagger your strikes. Say, well, look, I'm gonna effectively scale out of this position. 2% higher, I'll sell 30% of it, and if it goes up another 2% from there, I'll sell another 30%. And you can sell higher strike prices, certainly for lower premium amounts as you go up, but scale out of your position so that if you get out of the whole thing, you're very happy with the result of the trade. While doing that, you can also stagger expiration dates, go up in strike price gradually and go out in expiration date. That will actually allow you to capture more option premium if you're selling options that are, say, 6, 8, or 10% out of the money. You can go further out in time to get greater premium. Number of things you can do there. Last thing I'll say about the covered call on the upside is that there is a circumstance where you would likely be influenced to just exit the entire trade, where it becomes all risk, no reward. Reflecting back on what we just covered regarding moneyness and time value. And what I said in the beginning, when you sell an option, you are trying to capture the premium associated with the options contract, specifically the time value. In this case, for the covered call, we're trying to capture time value. When the time value goes to 0, there's nothing left to gain on the covered call. If the stock is above the strike price and the time value is 0, there's nothing possible that you can gain further on the position. In that case, when it's all risk, no reward, that's a time to consider just exiting and moving on to the next trade. A quick example with numbers on that, same ones as before. The stock's at 65. We sell the 70 strike call option. Doesn't matter what we sold it for. Stock moves up to 75. We've made all we could on the stock itself from 65 up to 70. Now the stock is up $5 above our strike price, $5 in the money. If we look on our options chain and we see the option trading for $5, that means there's no time value left. There's nothing left for us to get out of this position. Usually a good time to consider exiting and moving on. Now, if the option is trading for $6 or $6.50, you have something to consider. There's another $1 or $1.50 that you can further gain from the erosion of the time value from one day to the next. All the while, if you try to capture that, you're under the risk of the stock turning and moving against you. But keeping in mind how to calculate intrinsic and time value and then managing the position appropriately is very useful. That's enough on the covered call. Cash secured put, one of the other most popular trades out there. It's just like the naked put, except you have the cash on hand. This is usually done it's undoubtedly done if you don't have a stock position. You might be looking to profit just from selling the option itself, or you might be looking at this as a way to get into a stock position, obligating yourself to buy shares at a strike price that you're comfortable with. The goal here might be to actually be assigned to get stock below their current levels. If you're looking to buy stock at 65, it's trading at 70, but you sell a put for $1 or $1.50, your net cost is actually going to be below that 65 level. So it's a way to try and get into the stock without having to buy shares at their current levels and effectively try and get them at a bit of a discount. There's a difference. This isn't exactly like working a limit order on stock. The difference is that limit orders get filled as soon as your price is touched. Options contracts are not going to fill you on the stock side unless it's expiration day. So on the option here, if the stock drops below the strike and then subsequently rallies, you probably don't get assigned on that and don't own the shares unless the stock is below the strike on expiration day. That's not too big a concern, because if you find yourself in that position, the stock's $1 or $2 below the strike, I really want these shares. Maybe you've got another week and a half until expiration. At that point, you can decide to go ahead and proactively close out the put and buy the stock. I'm not sure what the profit and loss would look like on that. You might actually be buying the put for the same or potentially even less than you sold it for. But the idea is, if you find yourself there, you can proactively go in and get stock right at the level you want it, or If you're not too concerned about it, wait to see where the stock goes and maybe get assigned at expiration. Those are the two most popular trades when it comes to selling options, the covered call and the cash secured put. Let's flip into the Greeks and look at what it means to have Greek positions from the sell side and what kind of exposures are there. First, theta. Now, this is the most important one. I've mentioned time decay a few times previously. Theta is the Greek measure of time decay. You can look this up and it would be expressed in decimal form representing a cash number of the expectation, all else equal, of how much the option will lose value from one day to the next. And I stress all else equal, or here it says all other pricing factors constant. As I said before, the stock can move around in different directions, and that theta, that time value, can disappear and come back. But all else equal, you can look up the amount that you would expect the option to lose from one day to the next. And calls and puts both have negative theta amounts. That's just the option themselves because they're losing value. We're on the sell side, so our position should be positive theta. Owning options means you're losing from one day to the next as that gradual decay of options occurs. But from the sell side, our positions will be positive theta. And if you have more than one short option, you can just simply add them together. If you're looking for an estimation on what is my position theta, my theta position overall from one day to the next, it's arithmetic. Add up all the thetas and see what the net amount is. But selling options has positive theta. And this is a look at how time decay occurs. It's not the same for at the money and in the money options. That's because, first of all, in the money options have far less time value to begin with. And in the money options just gradually gravitate towards parity, or gravitate towards their intrinsic value. So it's rather a slower, more linear decay for in the money options. Same thing with out of the money options. But at the money is different. You're at that 50 delta level, right exactly where the stock is trading. Your strike price and stock price equal to each other. Those options don't decay very quickly until you reach about 6 weeks or so until expiration. And that's where that arrow is pointing, in that rough gray area around 40 to 45 days until expiration, when the acceleration of time decay begins to increase. Option sellers are trying to capture that time value, so it's less likely to see sellers go out much further beyond that 6 to 7 week time frame. You certainly could do it, and if you go further out in time, you're actually capturing more premium. The further out you go, the higher the dollar amount is going to be, but the rate of decay as you go out beyond that time frame of 6 weeks or so is going to be slow. And then once you get to 45 days, it picks up, and as you can see, the acceleration of decay continues to increase all the way to and through expiration. On this curve, as you reach expiration, while the acceleration of decay is increasing, the open market value of the option is decreasing with less time to expiration. So choosing your expiration date to open the position is weighing those two considerations. How fast is the acceleration of the decay? You want as much of that as possible, and how much can I get for the option? Those two things have to be balanced. They don't work hand in hand. The closer to expiration, the greatest rate of decay you'll get, but the lowest premium amounts you'll get. So you'll have to decide where the sweet spot is for you, and it's probably going to be different from one trade to the next. Also, one other thing to point out is where is theta just in general? Where is it the greatest? Well, it's the greatest at the money. We just covered that. It's also greatest for near-term options. As you go out further in time, it's slower and slower and slower. So for theta, it is greatest at the money and near term. And we can look through the different Greeks as well. But first, some numbers on theta, just to see why it's important to visualize how this can be. Looking at theta amounts with different expiration dates. On the left, we have a stock at 50, 50s on both sides, but the implied volatility level is different. And these are at the money options with 20% implied vol. And you can just see as you go from the 365 days till expiration, 1 year out, all the way down to 5 days, the theta continues to increase and the option premium amount gets smaller and smaller and smaller. You're going to get an incredibly quick amount of decay there at 5 days, but a smaller amount of actual premium. If the stock never moves and this option ends up at zero, you can make more money possibly by selling that shorter term option. But what if it does move? What if it actually moves a bit lower? Maybe you're a bit bearish when you sell this particular option. If you do it outright. Well, then in that case, selling the option further out with higher premium is going to be a bit more profitable. So you can see how that differs. And from the left to the right, going with 20% implied vol up to 40% implied vol, you can see how that certainly just about doubles the premium. And that can really highlight the effect of implied volatility. While we're here, and this is where I'll get into a bit on gamma and vega. When you sell options, you're selling gamma. First of all, what is gamma? Gamma is the acceleration of your deltas. Deltas change as the stock moves. And the question is, well, what direction are they changing? Are they changing in my favor, or are they changing against me? And when you buy options, you buy a call option that has a 50 delta, you want that 50 delta to become a 60, to become a 70, to become an 80. And if it does, you are making money. You're positive gamma. If it goes down 40, 30, 20, if it's going in the other direction, or say going in a negative fashion, your P&L on that trade is going in a negative fashion. So it's a positive correlation or positive gamma. When you sell options, it's the opposite. If we sell a 50 delta call option and it moves in a positive way up to 60, 70, 80, that's working against us. So selling options has negative gamma. If you understand gamma a bit, what that means is you don't want stock movement. Now, the Greeks can sometimes be a bit difficult to grasp and totally understand, but by and large, if you're doing a thorough analysis and a common sense evaluation of premium in relation to pricing factors, you're incorporating a Greek analysis, and you might be thinking about gamma if you didn't even know it. But the last thing I'll say about gamma is it is greatest at the money and near term, just like theta is. And that makes sense. How fast is the delta going to change if the stock price movements? Well, if there's 1 minute till expiration and the stock is at my strike price, or it's at the money, and the stock's moving up and down, above the strike, below the strike, that delta is going to be flipping around wildly from 50 to 100, from 50 to 0. That's a massive changes in your delta, and that means gamma is at its greatest. Much, much further out in time, a 1 year option is going to have rather subtle changes in its delta. So gamma is going to be smaller as you go out further in time and away from at the money. It's logical. And what about vega? Vega is our exposure here as well. We sold volatility. We don't want it to go higher. That would work against us as option sellers. So what's the exposure there? Vega is greatest, similar to the others, at the money, but vega is actually greatest long term. Vega is the expectation for how much the option premium will change in value for a 1% move in implied volatility levels. That is greatest further out in time. If implied vol goes from 31 to 32, that's going to have a greater monetary effect on longer term options. In our case, being the seller, a negative effect on longer term options. So there's theta exposure, there's gamma that you have to be concerned about. That's rather simple to understand what the gamma is all about with respect to not wanting the stock to move. And then there's implied volatility exposure. And now you have a sense for where those are the greatest and where they are the least. I want to shift gears a bit from all of that. That was heavy into selling calls, selling puts, and some Greeks and some concepts on premium. This final section here is a bit more simplistic, but some interesting background with respect to exercise and assignment rights and obligations. I already said most contracts are closed before they ever reach expiration, but sometimes they actually do get till expiration. So what happens if that is the case? Well, the buyer has paid for the right to exercise the contract at their discretion. That's what they paid for. In order to do that, they need to proactively notify their brokerage firm that they want to exercise the contract. Now, there has to be some kind of a default process that the industry takes on if the buyer doesn't communicate any instructions at all, and that is known as AutoX. That's sort of a shorthand term. It's actually called exercise by exception. The industry will compare the strike price of the option to the last traded price of the underlying stock in regular trading hours on expiration day, compare those two numbers, determine the moneyness status of the option. If it's in the money, then it will be exercised on the buyer's behalf. Even if they haven't told their brokerage firm to do so, it will happen. And if the option is determined to be at the money or out of the money, then it is abandoned. And that will happen whether the buyer communicates anything or not. So that's something buyers need to be aware of. Quick example, investor buys a March 80 strike call option. They pay $1.50. Now the stock has rallied. It's gone from 79 up to 84. This investor decided not to buy stock. They bought the option instead. There were reasons for that, but maybe now the reasons have changed, and this investor thought, well, it's going to go one way or another. It's taken off to the upside. It's moved a decent amount. I don't know what that is, 7-8%. And now they want the shares. They don't want to get out of this position. And that would be the motivation to go ahead and say, okay, I'm going to pony up the cash and buy shares now because it's already moved in my favor. So I want them. So taking delivery of 100 shares, paying the strike price of 8,400 leaves this investor with an open position of long 100 shares and an unrealized profit with a cost basis of 81.5. As I said before, most options investors will trade out of the position before getting to exercise. In our case, this option ends up $4 in the money. So the holder of this option is going to try to sell it for $4, and they probably can't. The bid-ask spread is probably going to be, who knows what it'll be, 390, 410 or something like that. But most likely this investor is going to have to sell their option for a little bit under $4. Just a bit of a note on that: when you see wider bid-ask spreads, it largely has to do with the stock bid-ask spread itself. Professionals who are market makers have to hedge their position. They don't want to take on any deltas. So if they're going to purchase this option from you, if you're trying to sell it, then they are going to have to offset that long delta position by selling stock, and they'll look at the bid on the stock and how much there is on the bid side, and that spread on the actual shares between the bid and offer will dictate to a large extent the bid-ask spread on the options contract. From the sell side, what is a assignment? Well, we know when we sold the option, we took on the obligation to execute a transaction in shares of stock at the holder's discretion, selling shares in the case of a call option, buying shares in the case of a put option. And this happens if the option writer is assigned an exercise notice. The writer has no say in the matter. They can't express an opinion or a preference to their brokerage firms. Option sellers are the only ones that can be assigned. And similarly here, if we had the same exact option, but now we sold it for $1.50, if assigned on this in the money option, the investor will collect or receive cash in the amount of the strike price, $8,000, and deliver 100 shares of XYZ. If it's an outright position that never had stock to begin with, then there is an unrealized loss and a short stock position. Most likely, in the vast majority of cases, this investor would have already owned the shares from some price below 80, and when assigned, accepted the sale of the shares at 80. When you add in the option premium, they effectively sold stock at 81.5. Now, certainly that's not as good as 84. So this investor might think, well, I gave some money, I left some money on the table, but they were comfortable with that when they went into the position to begin with. Now, assignment process, just going to walk this through, whereas the exercise process starts with the investor and works its way up to the clearing corporation, OCC, that handles all of this. Assignment works the other way. It starts at the foundation of the industry. That is what OCC does. There are clearing member firms of OCC. There's about 125, 130 different firms that are designated clearing member firms. They all hold positions at OCC. If you have an open short position, either directly or indirectly, OCC knows about it. And what they do on expiration day for all those open assignable positions is they run an SEC approved mathematical equation to randomly assign their clearing member firms. You may have an actual account with one of these firms, or most investors have accounts with trading or brokerage firms that do business with clearing member firms. But the chain of communication will start with OCC, go to the clearing member firms, and then through one of those, either of those, depending on where your account is, you'll be informed of the fact that you were assigned. Most of the time, that'll be by the next trading morning. You should already see the assignment activity in your account. If you haven't gone through it before and you're not familiar with it, it's certainly worth asking your firm how they communicate to you and what you should expect to see in your account on the day following expiration. Also, pin risk. Pin risk is really important. It only exists from the sell side. And what is it? Pinning occurs when the stock settles close to the strike price at expiration. Pin risk, you can actually also say, is the risk you have even prior to expiration of not knowing what the option holder is going to do. You don't know if this option is going to finish in the money, at the money, out of the money. Regardless of all of that, you don't know what the option holder is going to do with their contract, which leaves you with uncertainty on whether or not you're going to have a stock position having to deliver shares or purchase them. You might be okay with that. Some investors might think, well, if I'm assigned, I'll take assignment. And if I'm not assigned, I'm okay with that too. And then you can let this whole thing play out. But frequently, the case is that the option seller would like to know, what position am I going to have come, say, the Monday morning after expiration? I want to know what that is. And if you have the stock trading right at the strike price, you have a high level of uncertainty. Now, you always have uncertainty when you sell options. I'll say that as a general statement. When you sell an option, you are, from an educational perspective, you're never 100% sure that you're not going to be assigned. You certainly can feel extremely confident when the option is out of the money that you won't be assigned, but there's a level of uncertainty. That level of uncertainty increases the closer the stock is to the strike price, and that may lead you to have incentive to take some action. Sellers need to be aware of this uncertainty, which includes overnight risk, and put commit capital when necessary, and the potential for even after hours market moves. To put numbers on this, a seller short the 270 put, and I get this kind of example posed to me all the time, that things that just happened. Short the 270 put, shares trading just above that, heading to the closing bell. This investor will tell me, hey, look, I'm watching the market. It's trading 270 in a quarter, 270, spot 3. And I'm watching it all the way through the closing bell. The underlying stayed above 270, and I was assigned, and they think something wrong happened, and they were inappropriately assigned because Monday morning this thing is trading down at 266. If they're assigned, of course, they have to buy stock. $27,000 worth is the cash outlay to buy those shares at the strike price of 270. And you wouldn't want to wake up Monday morning thinking, I'm okay, this thing expired 30 cents out of the money, and now all of a sudden you own 100 shares and it's trading down $4 or $5, something like that. It's not something you want to have to endure. However, the right of the option holder has nothing to do with where the stock is versus the strike price at the closing bell on expiration day. It has nothing to do with it. The option holder can exercise even if it's not in their financial best interest to do so. And certainly prudent investors who hold options that are that close to the strike price will watch after hours activity and see, is this start to move? Undoubtedly, and in the cases that I get, when I watch the time and sales, I'll see, well, yeah, it closed at the closing bell at 270.3, but then there was some pretty big after hours activity. It was trading down, at the 269 handle during after hours. And if you're an investor holding the 270 put and you see that, you'll call your brokerage firm up and say, hey, look, I think I'd like to exercise my put option. I know where the stock expired, but after hours activity is going to lead that discussion. And if that happens, then you can certainly be assigned on the flip side. You really want to be aware of that if you're selling options and you're evaluating the likelihood of being assigned. The only way to take that possibility off the table is to not have an assignable position. I understand the motivation of trying to squeeze every penny out of a trade. I've done it many, many times myself, trying to get every last dime I could out of the trade. It's just not always possible to do that without taking on an unnecessary amount of risk. The only way to avoid the possibility of an assignment that you don't want is to buy to close and exit the position. Usually firms have, or buyers have, about 60 to 90 minutes after the closing bell to inform their brokerage firms of their exercise intentions. That time frame can vary from one firm to the next, but that gives you some idea of just how much time the buyers have to watch the market, watch after hours activity, see what market conditions exist, and then further make a decision irrespective of the final moneyness of the option at the closing bell. So again, our website, optionseducation.org, and our email address, the investor services guys, are very helpful and knowledgeable. Option@theocc.com. There's our social media sites. And again, if you want to go to our website, to our events section, check out our upcoming webinars highlighted by the October 23rd session with Larry McMillan that we're really excited about. So that's everything I had for you. I think Maria might come back on to wrap things up and possibly have a few questions. We've got a couple minutes.
Yeah. And Teresa's going to grab questions from Discord. I'll grab questions from the webinar. So guys, you can type your questions either direction. Stephanie had a question. What level should the desired delta be?
What level? So I'm thinking this question is, what delta should I be looking at when selling the options contract? Certainly, this is a question that's going to change from one trade to the next. One little trick a lot of people use, this is not mathematically completely correct, but one of the definitions of delta is the likelihood that the option is going to finish in the money. I was actually taught that definition, so it's not a back of the envelope type of thing. It's a valid estimation that the market is providing to you on the likelihood of an option finishing in the money. So a 30 delta call option, the market is estimating there's about a 30% chance that this option is going to finish in the money, and some investors will use that to help guide them to decide, how conservative do I want to be? Certainly the further you go out of the money, the lower your deltas are going to be. That's good, but the premium you receive is going to keep going down and get less and less. So you're weighing those two factors against each other. Your confidence level and your opinion on the underlying, your motivation, your risk tolerance, and then maybe some semblance of that delta and the likelihood of finishing in the money will help you lead to that decision, but no one concrete answer will come through. You'll choose different deltas depending on different circumstances.
Perfect. And there's a quick note from AJ on a covered call. Your stock can be called back if you are in the money and you have a dividend and there's a dividend date. Please close it or roll it to a higher option price, as you might be responsible to pay the dividend. So if you start writing, make sure you pay attention to dividend dates.
Yes, that's a good point. So if the option is in the money and it is the day prior to the X date and there's no time value left in the option itself, then there's a very good chance that you will be assigned. Of course, you could be assigned if it's just in the money in general. And this is actually a gray area. I could spend quite a bit of time on this, but just being in the money, if I was an option holder and the option was in the money, but there was actually time value in my option, I certainly wouldn't exercise it. I'd sell the option and then I'd go ahead and buy the shares. But you can capture both time value and dividend if there is time value in the option. If there's zero time value, then yes, I would expect exercise to occur. Point well taken. The day before X date, if there is a dividend payment, you need to be concerned that assignment could very well occur if you don't own the stock. Of course, you would owe the dividend. If you did own the stock, your shares would get called away and you wouldn't capture the dividend.
Thank you, thank you. And then we have a question. Do market makers take opposite positions by selling or buying stock based on the number of contracts X gamma of that position for every tick?
I was following that question till the end. So X gamma?
The number of contracts, I think he means X being the number of contracts,
Okay,
maybe?
could
Or
be. Well, I think, yeah, the way I was following that question
multiplied.
is that it was
Sorry,
exactly
multiplied.
correct. Or times gamma. Okay, no, not times gamma. So the market maker is going to calculate the delta exposure of the position that they just took and then sell or buy stock on the opposite side to offset the deltas. Now, as the stock moves, the deltas are going to change, and that's where gamma comes in. It's not times gamma, it's ignoring gamma today, but subsequently the gamma effect is going to dictate whether this market maker has to re-hedge their position later in the day or tomorrow. Even though they haven't traded any more options, they have to re-hedge because the deltas have changed as a result of gamma. I hope that made sense.
There's another one from Jesse. He said, if we choose to write contracts against commons that we own, would it be wise to sell weekly since they expire sooner?
Well, I can't give advice, but I think this answer is pretty broad. And to say, is it a smart thing to consider? Sure. If you sell weeklies, you're going to have to go a little bit closer to at the money to capture enough premium to make it worth your while. You might be going 1.5% out of the money to get an actual premium amount that is even worth taking on the obligation. That means if you get quick spikes in the stock price, you're going to have to give that up and you're going to see money left on the table. However, when I traded weekly options all the time, if I was selling a call option 1% out of the money and I was actually also able to capture, say, 0.5% of the stock price value in premium and I got a big pop, well, it was hard to complain about making 1.5% in 1 week. So those are complaints that you didn't make as much as you otherwise could. Those are the complaints that I'll take all day long. It's a smart approach. You just have to be cautious because you're selling your options so close to the at the money strike that you might be giving away your stock far before you want to.
Perfect, thank you. We have time for maybe one more question. Teresa, do you have anything over on Discord?
I don't.
All right. Well, unless someone types something real quick. I think that may be all the questions that we have. So Ed, I'll let you go ahead and get wrapped up.
Great. Well, listen, I enjoyed it as usual, and hopefully I'll be able to squeeze another event in with you guys before the end of the year. I know with November, December, I've got plenty of travel and holiday obligations and time off and such, but I think I look forward to seeing you guys at least one more time before we turn the calendar into 2020.
Awesome. And again, thank you once again for an awesome, amazing class. And guys, if you have more questions, I think Ed has already given you how to contact them if you want to ask them, or you can ask us in Discord.
Thank you again, Ed. It rocked.
Thank you guys. Thank you very much. Have a good day.
Have a good night, everyone. Bye.